Hey, everybody. Hopefully you're killing it in the markets. My name's Andy. My channel's Finding Value. If you guys are looking for undervalued investment opportunities, click subscribe. I'm doing some financial education this time. I call this one correlation. And what I'm doing is I'm correlating housing starts, which is basically expansionary phase. I'm looking at the end of an expansionary phase when it starts to decline. I'm going to put that on and overlay it on some charts to show you guys how this stuff's correlated. I'm also going to take the S&P 500 to commodity ratio. I'm going to take our buy and sell points and correlate that to some commodities as well, so you guys can see how this stuff is correlated together. So let's jump in. I'm going to show the correlation presentation and show you our buy and sell points, basically, and how well they're correlated. So I'm looking at housing starts and certain assets, commodity assets. I want to correlate and even some other assets like S&P 500 and stuff. I want to correlate the housing starts, real estate to real assets, and show how the correlation between them. We can then use one as an indicator of when to buy and sell assets. Again, this is only financial education. You guys are going to have to do your own due diligence. You have to see if this strategy fits within your financial strategic approach. So let's jump into it. What I did is this is the housing starts. This is the new privately owned housing unit starts. The housing starts is just basically new homes being built for residential real estate. That's all it is. And what I did is I put a red line wherever this thing starts to turn down for housing starts. Red line, red line, red line, and red line. And I put some of these depending on where this correlates with what we're looking at and the chart series, like the time frames. So here is the commodity to S&P 500 ratio. It's cheap when it's down here. So we've got a green, this would be a green circle here, and then the red circles up top. And then we've got another cheap buy signal, signaling that commodities are cheap in relationship to stocks or the S&P 500. I took these circles and I overlaid them on the charts. And I only overlaid it if it was a green to a red. There was no green buy down here, so I didn't overlay anything. It was just green to red, green to red, green to red. Okay? So here's the first one. It's oil price. The housing unit starts ended 1973. So this is off a little bit. This is the beginning. This is the beginning of the housing start. So hold on. For this, we have a crash. This was 73. All right. Because some of them I put at the beginning. This is at the beginning. This is 1971. This is the beginning. And then the end was here. So we threw the line here. We have this is the beginning of it. That's 1971. That's why we have the green. We've got the green buy point, and then the housing start sell point was here. So this sell point should be moved over because it's 73, which would be something like here, somewhere where this red line is, something like that. 70's here, 73, and then 75 would be here. I had it in the wrong spot, and then we can delete this one because this was the other sell signal, and this was the other sell signal here. But these didn't have any green buy points. So it should look like that. Green buy point, the sell point, and then we also had a high. So the housing starts rolled over, and then we had a sell signal on the S&P 500 to stock ratio. Buy point, sell point. Buy point, and we even had the housing starts right here. The housing starts started to decline, and then it's like it's time to get out soon. Housing starts started to decline, time to get out soon. Here's platinum price. So in 1971, it threw a buy signal saying that we should be buying commodities. Went all the way up. We got a sell signal here for a S&P 500 ratio to commodity. And this is the housing starts that went down. So this one started to decline. We should be looking to sell soon. And there it is. There's your sell signal. Buy signal, housing start decline, sell signal. All correlated. And then we had threw a buy signal all in here. So platinum looks good to continue far higher. Here's what it is on interest rates. These are all interest rates. It said buy down here, and then the housing starts. So we had an increasing interest rate environment. We had one here. It came up, and then they forced rates lower because of the 2000, 2001 crash. So rates went down because a crash was coming, and then they went back higher because we had a real estate boom. So they were messing with rates, I think, and we had a crash in the middle of this real estate boom, and then the sell would have been at the top right here. It would have been red right here. And then the crash. This was the crash after it. Here is the S&P 500. What I did is I put a recovery phase, expansion phase, and recovery phase based off of the real estate cycle on the housing starts. So in 1990, we were in a recovery phase. Like, I can show you that if you want. In 1990, we were in a recovery phase here, recovery, until we get to about 95, no, sorry, all the way to about 98, 99, because that's when we start kicking into an expansion phase. So we've got 90 all the way up in a recovery phase, all the way to about 99, 2000, somewhere in there is when we started going into an expansion phase. 98, 99 was when commodities threw a buy signal to buy commodities. So you could sell out here and swap into commodities. In the expansion phase, which is this phase in here, shows that the S&P 500 didn't do very well in this expansion phase. And the expansion phase ended right here. This was the hyper supply phase in 2007. Inventory went rocketing higher, and then we had a recession. This is actually recession right here. This dark line here is the recession of the housing market, which also impacts stocks. So we had a recession, a blowout recession, which blew this out to the downside. Then we started a recovery phase again, and the recovery phase was quite strong for a movement. And right here, we are entering an expansion phase, which is way up here. And I think this is going to go back down. I don't think it's going to continue higher. I think it's going to do something like a sideways movement or chopping pattern or something like this, or it goes around like that. Something sideways. Now here is, let me see here. Of course, I didn't write what this actually is. So we were at here. Oh, this is the S&P, no, Nasdaq. This is the Nasdaq. So Nasdaq, we threw a sell signal, and the housing started to decline. The Nasdaq got smoked. Came all the way back down. We've got a buy signal for commodities, and look what happened to the Nasdaq. It went down, 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 and sideways. We threw a sell signal for commodities, also with the housing starts about to crash. It threw a crash. It threw it all the way down, and you want to buy it in a recovery phase. In 1990, this right here, 90, is a recovery phase all the way to about 2000. So recovery phase here, and then we have another recovery phase here. And I think what's going to happen is we're throwing a buy signal just like here, and I think you're going to see the Nasdaq come on down. That's my guess. This is the S&P 500 PE ratio and U.S. interest rates. So whenever interest rates start to increase, the PE ratio starts to decrease. So we had an increasing interest rate environment here. You can see the PE ratios contracted. We had a declining interest rate environment here. PE ratios shot far higher, and they remained elevated during this period. We had an increasing, well, this was a flat interest rate environment here. Didn't really go much of anywhere. And then we had an increasing interest rate environment here, which resulted in a declining PE ratio over time. And remember, these things aren't completely correlated. They are and they aren't, because you can see this thing kind of move higher, and then 66, it declined. We had a declining interest rate in 81. We've been declining or increasing. And then we're coming on down over time, I think. The PE ratios will, I think they came back up. I think they actually came like this back up to 20. And then I think we're going to come all the way back down. This is the uranium price, just to see how it correlates with the uranium price. It says buy signal here, housing starts ended and a sell signal here. And then we had a buy signal here. We had the housing starts end here and then a sell signal here. So it correlates fairly well. Not perfect, but fairly well. So that's how it correlates. That's how these things correlate over time. You can see that you can use it for stocks and the Nasdaq. You can use it for commodities to the ratios, that is, to time your buys and your sells. And then you can use the housing starts when they go and they peak and they start going down. You can use that peak. You can put it on the chart and you've got maybe 6 months to a year to take some action. And then if the S&P 500 ratio hits your sell point, that's when you go, because the housing starts are starting to decline. So that's it correlated. That's what it looks like. I just wanted to show you all you guys kind of the buy points and sell points and what I'm using. And that's it. If you guys have any questions, any comments, leave it in the comment section below. And thank you for listening. This is Finding Value.